The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to Digging into the BI. This is the first one of the 2025 calendar year, and this is where the DC Regional Chapter and the Maryland Chapter get together and look at the featured stocks from the January issue of BI, as well as two additional ones. So we have four new stock presentations for you tonight, and we're glad you're here. Next slide, please. Here's the standard disclaimer. We are doing these presentations for educational purposes. We believe, as BI does, that you should conduct your own review and analysis of any companies. If we do talk about stocks, we'll try to alert you whether they're in our club or, personal portfolios. And again, if we're showing you something outside of the BI community, it's not an endorsement or promotion of those websites. And this presentation will be recorded for future use. And anytime you see this blue underline on any of the slides, if you have the PDF on this, it's a hyperlink that will take you there. Next slide, please. So again, I see a lot of regulars, but just in case this goes up on YouTube and you see it, this tells you a little bit about Better Investing. Again, a hyperlink. We're an investment education organization. We focus on long-term fundamental investing. And all of us that are doing this, we're volunteers. And I say in the Mid-Atlantic region, but we have two people that used to live in Maryland or Virginia that have now run down to the south to Georgia or Alabama, and they're coming back as a preview. So thank you very much, Kent and Helen. Next slide. So here's a YouTube page, and you can find this again, literally, if you just go into YouTube and type in Digging into BI, you'll find it. We're actually up over 200 subscribers now, which is pretty good. I know that's nothing like the big people do it, but again, this will go up there later on tonight or early tomorrow. Do us a favor. This is free, but go ahead and like the videos, share the videos, and subscribe to the channel. That's how the algorithm works, and it helps us. And all of the webinars are organized with what are called chapters over on the right-hand side. That means you can just advance to the stock you want to look at or the part you want to look at. If you want to fast forward through all of this, you can do it. And you can do that just by hovering down at the bottom, and you can see where the breaks are. Next slide. So if you, again, we haven't anyone asking about the troubleshooting in a while, but the last one down there is the green arrow, and that's where the handouts are. So we have 5 handouts for you, 4 completed SSGs plus this slide deck, and you can share those SSGs and the slide deck with people in your club or friends that you're trying to get interested into better investing in the investment clubs. You can share that and show it to them. So that's fine. Next slide. So why are we doing this? Well, we're doing this because we want to be able to show people how to use the Better Investing magazine and the resources to find stock ideas. And if you're not a member of Better Investing, there's up at the top again another hyperlink for a free 90-day trial on this. And we're doing this webinar to be able to help beginners, people that are uncertain of their judgments, or just people who want to be part of this community, showing you how to use the 2 forms that we use a lot of, the stock selection guide and the PERT report. And we're trying to show you the best practices that a long-term fundamental investor inside our community would do. And again, this is a joint program from both the Maryland chapter and the DC regional chapter. We have some model clubs as well as a Club Connect, and just to be part of the Mid-Atlantic region, Maryland, DC, and Virginia. And if you're not from that area, you're welcome to be here. We're glad to have you. Next slide. So in just over an hour, we're going to present 4 stocks. 2 will be the featured stocks, and they only come for, you can only get access to it if you're member only. But these slides, again, you can be able to, you will have our analysis of it. But those are the stock to study and undervalued feature. And then we try to find 2 other stocks just using the resources of Better Investing and not going outside of it. So it can be from the magazine or the website. And tonight, the 2 new stock ideas, other than the featured ones, are going to come from the predefined screen. So we'll show you a little bit about that. Next slide. So again, you can find this stuff, and you don't have to be a BI member. But these stocks were announced back in late October, and also you can be able to take a look at that, and you can see they already have the ones up for February. Um, and the like. So go ahead and take a look at those things. If you want to be prepared for when we do this, you can always sort of do your own analysis. And that way, when we get to question time, you can be able to participate. Next slide. So we also want to be able to alert people to things that are going on in our community. And we ask that you get the announcements that come both from the chapter, your respective chapter, as well as from headquarters. So you can do that under the red circle where it says My Account. That opens up with the screen capture over in the center left of the uh, page, and you go to email product subscription. They have the green circle there. It takes you to the screen capture on the right. And there where the arrow is, that's where you can sign up for the local chapter news. And then before you want to close out, take a look at it's up at the top. It's the BI Weekly e-newsletter. Click on that as this one's done. And that way you can then hit save changes and you'll get it. And if you have signed up for this and you're not getting those announcements, check your spam filter. Next slide. So here's what you get by signing up from headquarters out of Detroit to see the weekly newsletter. This is just for members only, but they show you events that are coming on. Again, many of us are in investment clubs, and they have a treasurer's workshop to be able to help out with the annual audit. That's where that sort of orange arrow is over on the right-hand side. And then we also have different events like Ticker Talk and Stock Up. And here's a Ticker Talk that's going on next week, as well as different places for stock ideas and stuff that's coming out. And again, if you signed up for this and you're not getting it, check your spam filter. Next slide. So we can also connect with the Facebook page. We do have one for the DC chapter. You don't have to necessarily remember this URL, and you can just sort of search under DC, Better Investing in DC chapter. The Maryland chapter hasn't really been doing much there. So we've been trying to put things on both the Maryland and DC chapter there. And again, you don't have to be a member of the Better Investing community, and you don't have to be from this area to participate in getting it. Next slide. Cynthia, why don't you tell us what's going on in the Maryland chapter?
Gladly. Good evening, everyone. So in the Maryland chapter, a couple of things I want to pull out is if you go under, of course, home and then you get the chapters, look under the Maryland chapter link. It lists everything there, your local, your contacts and all that. But I'm pointing out the news and articles that we have coming out. We have some great things coming up in January. The first thing, January the 8th, which is next week, we were partnering with the the Baltimore County public library system to do investment 101 for a lot of Baltimoreans. So I'm excited about that. It's the board effort. It's going to be great. And then also the 25th of January, which is not pulled out and listed here, just want to bring up Stock Pickers Contest. Definitely. If that's intriguing to you, please go under the Maryland chapter page here and pull up the Stock Pickers Contest. It's in the smack in the middle. The 2025 Stock Pickers Contest is going to start on the 25th of January, and it goes through August. So it's a great game. It's a great competitive game, and I think you'll find it very interesting. Next, we have on the 12th of April, we'll start our in-person SSG class. So we will be down in Prince Frederick, Maryland, and we're looking forward to having a full class. And the board will definitely be there in person to be able to present to you and show you some tips and the methodology of the SSG tool within VI. And the newsletter, Money Matters newsletter, the Maryland Money Matters newsletter. It just came out the first of the year. This is for the fall winter 2024. But again, great information in there. Go into the Maryland chapters site and look through that beautiful newsletter. It has great article on two of our clubs in Maryland that have been around for a quarter century. Very interesting information. Thank you, Kevin.
Thank you. Yeah, I love that newsletter. You do a great job with it. Cheryl, tell us about what's going on in the DC chapter.
All right, so Money Matters right now, we're looking for a new person to kind of head that up. Ann Bradley, who's been doing it for more than a decade, is no longer able to do that. So if somebody out there is interested in picking up where she left off, we would be glad to take you as a volunteer into the chapter, or if you're already in the chapter. In with the McNova Model Investment Club for January, the education is bank stock analysis, and the new stock presentation is Yeti Holdings Incorporated. Kevin, do you know what MCMC is doing for January?
Yeah, and I think we even have some slides if we advance ahead.
All right, and we'll go ahead and do that then.
Cynthia gets to go first and tell us all about In the Black.
Awesome. I couldn't get off of mute. Me again. So the Maryland chapter, I belong to also, and I'll mention it later. I belong to the In the Black Investment Club. We are out. We're under the Maryland chapter, but we are an online club only, and we are in 3 states: Maryland, New York, and Virginia. Again, we're online only. We started in 2021. Right now we have 7 partners. Our next one is this coming, is it the 12th? Yeah, the 12th. So the second Sunday of every month from 7:30 to 9. We're going over this educational portion is going to be on predefined screens because I just was taught that by Kevin. So thank you, Kevin. And I want to share that information with my group as well. Our stocks to study is that all of us will be presenting either a small or a medium stock this week coming. We have to build up our portfolio with small or medium. We are a little overweighted with our large. So that's what we're tackling. And everyone who comes that night, we all have to present a small or medium stock. And my point of contact, my information is there as well. That's my email. Feel free to reach out. I'm in the picture. I'm the redhead in the back. Thank you, Kevin.
Sure. And so, as Cheryl was asking, I'm in the Montgomery County Model Investment Club. We have 5 partners. I think we may get a 6th one here pretty soon. We meet on the 3rd Wednesday of the month from 7 to 9. We too are online, and there's a link to join us. Our education is going to be Valuation 101, and our stock study is going to be Green Brick Partners. So come and take a look. There's a picture of some of us. We do quarterly socials with a couple other clubs, and that's sort of a mix match of some of us from the 3 different clubs. Next slide, and I think it's to you, Cheryl.
Yes, we are the Model Investment Club of Northern Virginia, otherwise known as McNova. We currently have 14 partners. We meet on the second Tuesday of the month, which is going to be January 14th this month from 7 to 9 p.m. There is the link that will take you to our club meeting on the 14th at 7 o'clock. We're, as I said before, doing researching banks, and stock study is Yeti Holdings. And there's the point of contact. And the previous slide showed all of the events, and you can get that off of the BI Northern DC chapter events page. All right, and this is still me. BI is doing something called Club Connect. It was the old Visit a Club program, and now it's new and improved. It's not only for people looking for a club to connect with, but also clubs that are looking for additional partners for their existing club. So you can look there under investment clubs, go down to the green that has the red circle around it, and there you will find Club Connect. Fill out the form that is down there, and you should be hearing from BI Central soon. And please look for this special Connect. It is really catching on with members.
Okay, this is digging into the BI. We'd like to be able to show what's going on in the latest issue of the magazine. However, because we moved this to the first Monday of January, normally we do the second Monday because of the holidays, and because this is a 2-month magazine, January and February, they haven't released it yet. So we don't have anything to really show you other than what we did last month, and some of it we will keep there. But again, you can get this electronically as well as in the mailbox. So keep that in mind. Let's go to our next slide. Um, and here's where you can find, again, on the Learning Center for a member. If you look at the green arrow, that's where you can sign up to get the BI magazine for mobile devices. I have that on both my tablet and on my phone, my smartphone. And then also when they talk about additional resources for either the two featured stocks, the stock to study and undervalued future, where that red arrow is, that's where they have the additional information. So you can always find it there for whatever featured stock you're looking at. And the way you get to it is through that green box in the center that says View Magazine Issues. Next slide. So this is left over from last month. I just sort of kept it. I thought this was I really liked this article from last month, which were my best and worst investment decisions. So I won't read it all to you, but I found it was kind of worthwhile that, even someone who's been involved a lot like Vitaly here, we can still learn from what we're doing. And that's really the reason for being part of this community. Next slide. And the event page, again, most of the stuff that was in December was featuring stuff that was in January, because again, with the holidays, people weren't doing it. But the North Florida chapter does a series of stuff that's going on. They have one tomorrow night, their stock investment workshop. It's online and free. And then the South Florida chapter does stuff as well to take a look at. So go ahead and look at those things. They're online and free. But you can find that just through the BI magazine. Next slide. So we've done a lot of talking about the stuff going on. Now it's time to be able to look at the stocks that are in here. So we're going to have two stocks that are done in core. Kent's going to show us the stock to study Merck, even though we haven't gotten the magazine yet. And then I'm going to do a predefined screen with Toll Brothers. So Kent, why don't you take it over?
Okay, let's go on to the next slide. All right, hi y'all, I'm Kent and I'm from Huntsville, Alabama, and I am part of the Alabama Emerald Coast chapter. And tonight I'm going to talk a little bit, as Kevin said, about what I learned regarding Merck and Company over the past few weeks. Next slide, please. So Merck and Company will be listed as a stock to study in the January-February 2025 issue of the Better Investing magazine. They make pharmaceutical products to treat several conditions in a number of therapeutic areas, including cardiometabolic disease, cancer, and infections, and you'll see some other things too. Their substantial vaccine business, you might have heard of the interaction with Moderna, provides treatments to prevent pediatric diseases as well as human papillomavirus, or HPV, and that's usually associated with young people. Next slide, please. The firm's cancer-fighting immuno-oncology platform, which is a fun way to say, a lot of words there, is growing as a major contributor to the overall sales. Keytruda increases the ability of the body's immune system to help detect and fight tumor cells for lung cancer and gynecologic cancer. Now, this is a good word. Clesrovimab protects infants from RSV, or respiratory syncytial virus, during their first year of life, during the first RSV season. Additionally, the company sells animal health related drugs, and just under half the company's sales are in the US. So speaking of sales, let's look and see how Merck is performing. Next slide, please. First, you'll notice that the earnings in 2023 tanked. I mean, that was just a big red flag there. But if we look at the sales, they've been relatively flat for the last 10 years. And so my big question was, should we expect really any growth? Then even without that huge drop in 2023, the earnings are fairly bumpy. And the question is can we make money with those bumpy earnings? Also, the price growth has been relatively flat. It's taken 10 years to double, which is slightly greater than a 7% growth rate. And that's on the high end of what we can expect for a large company. So that's pretty cool. And Merck is a giant company. So we get to incorporate dividends into the growth analysis. Next slide, please. Now, looking at Merck's peers, the company is comparable or maybe even leading the peers and industry sales performance. So that's pretty encouraging. Next slide, please. For your perusal, here are some numbers for generating the previous graph. Next slide, please. Merck's earnings per share history, as I mentioned earlier, is a bit rocky. And I was wondering if there would be similar bumps in the peer group's earnings per share, and that kind of looks and kind of follows there, except for 2023. We'll need to investigate a little bit further to see what caused that 2023 challenge. But let's see how the company's managers compare to their peers. Next slide, please. So this graph has me asking, what are Merck's managers doing that helps the company stand out among its peer group? Because right now they're just kind of smack dab in the middle. Next slide, please. So, Merck is number 3 out of 4, which is not very encouraging. Next slide, please. If we look at the return on investment, for most of the 10-year period, Merck's managers provided a return on our invested equity at the bottom of the pack. This is depressing. Next slide, please. So if we look at the numbers, we can see that Merck is number 4 out of 4 peers, which we saw from the graph, but they're even below the peer group average and the industry average. Next slide, please. Now, their debt to equity is way better. Apparently, Merck has a second lowest debt to equity ratio of its 3 peers and lower than the industry and average peer group average. So that's really good to see. Next slide, please. So Merck is number 2 out of 4, and yet the 5-year average debt to equity is greater than Better Investing's benchmark of 30%. So we kind of are starting to ask, so why is this being recommended as a stock to study? So let's focus now on that substantial decrease of earnings in 2023, because that was a real exploratory dig for me. So next slide, please. Merck has really given us 2 2023 quarters in which we need to figure out what happened. Fortunately, both of these quarters were in the same fiscal year, so I only had to really look at one fiscal year. The annual report was very helpful in uncovering what company managers were doing and how they explained the losses on some pretty substantial revenues. Next slide, please. This was incredible. The 10K revealed that the EPS were, quote, negatively affected in 2023, 22, and 21 by those dollar figures there for certain upfront and pre-approval milestone payments related to collaborations and licensing agreement, as well as charges related to pre-approval assets obtained in transactions accounted for an asset acquisition. Okay, that's a lot of words. And that required even more digging into the murky financials. The 10K revealed some elucidation on Merck's business segments. Interestingly, Merck has 3 business segments, kind of matching its product segments. Next slide, please. So the 3 segments are pharmaceuticals for humans, animal health drugs for other critters, and other, which is, well, other is very, very descriptive. So we're going to go off and get our shovel and do some more digging. As you might gather, the pharmaceutical segment grew profits at 6% in 2023. The animal health profits declined by 12%. but other had a major loss, which the loss itself was higher by 72% of any of the previous years. And so what made up this, quote, negative profit, unquote? We might actually need a backhoe at this point in our digging. Next slide, please. Okay, so now we're getting somewhere, because if we look at all of those other subsegment profits, research and development expenses are the biggest contributor to that major decrease. And that R&D expenses in 2023 more than doubled compared to 2022 and tripled over 2021. And so your brain might be flashing some caution lights at this point, but what did Merck spend all its research dollars on in 23 that it didn't need in 21 or 22? So a major excavation is underway, and that revealed, next slide, please, a bit of a resolution. You recall back in Q2 2023, there was a significant loss of about $5 billion, which just so happens to match the acquisition cost of Prometheus Biosciences. In Q4 of 2023, there was a loss of $2 billion, which matches the Daiichi Sankyo collaboration investment. So that's a little strange. To have those things happen, to expense investments, usually we would put that and amortize it over several years. But it creates a path to profits with less future expenses associated with that particular investment. And so this indicates the expense of 2023 should, he says, produce associated income in the future. Now, perhaps we can get a better idea of Merck's future growth. Next slide, please. So even 2024 is proving to be a bumpy ride for Merck. Regardless, we're seeing a significantly more potential for growth in the company. From a negative EPS growth rate to a positive 13% growth rate is pretty significant jump. And I was wondering if that could be justified. Next slide, please. So compared to its peers, Merck's normalized growth rate is looking a little more reasonable. That 13.5% is what we get when we eliminate those investments. Next slide, please. So other analysts believe that Merck has room to grow, and but they're expressing cautiousness, predicting the future growth rates. So my thought is perhaps a growth rate of 13.5% might be a bit optimistic. Next slide, please. Value Line, on the other hand, is estimating earnings per share in 5 years at $12 per share. The company's financial strength is A+, so dividends are likely to continue to add to the growth of any investment. So that's really good news. Next slide, please. In the future, after reviewing input from several analysts, and you can see the names of them here, we can see some very conservative estimates for revenue growth and some highly exuberant estimates for earnings per share, with exception of Zach's 5-year growth rate. So that's helpful information to know. Next slide, please. So I found the earnings growth rate in 2023 to be an anomaly propagated by that decision to expense investments rather than amortizing it. And yet I extracted the anomaly, and that extraction yields a bit of surprise on the growth of earnings per share and pre-tax profit. Given the work the company's put into identifying acquisitions and collaborations, I expect a revenue growth rate of 6.6% to be a reasonable estimate, and an EPS growth rate of 7.7% to match that 9-year pre-tax profit to also be reasonable. So those are the numbers I'll use. Next slide, please. So we did a little forecasting, and that estimated EPS forecast growth rate of 7.7% yields an EPS of $6.91 in 5 years. Remember, Value Line said $12, so I'm being very, very conservative here. You might also note that the $86.9 billion of estimated revenue is higher than Value Line's estimate of $79 billion. And I'm good with this because Value Line is using estimates for 9 months older than the current data that we're using. So that's good as well. Next slide, please. The high EPS forecast is based on the 5-year forecast. The low is also based on 5 years from 2018 to 2022, but we eliminated the outliers in both cases from 2023. The low PE forecast produces a price greater than 80% of the current price, so I used the 80% price to give the company some distance to drop in price. Next slide, please. As you can see, Merck and Company has a potential to provide a good, reasonable return on an investment, even with some conservatism built into the analysis. Next slide, please. So in conclusion, Merck and Company is a giant, slow-growing company, and it produces great dividends that your grandmother would be happy to own, and perhaps your more conservative feline companion who appreciates Merck's medical focus on her. Because of the debt, modest revenue growth, and bumpy nature of Merck's net income and earnings, I would build caution into any analysis, and I would recommend a quick analysis after the annual report comes out in February. Thank you for your attention. Next slide, please.
Thank you, Kent. And now we'll go on to another stock. And you can take over the timing since I didn't alert you when you were going through it, but you hit your time mark fairly well. I'm going to talk tonight about Toll Brothers. And I found Toll Brothers through the predefined screens, and it actually showed up in 3 different screens: the quality screen, the value screen, and the A-list. It also has a first cut report that showed up in July of 2022, so 2.5 years ago. So let's go on and let's go to the next slide. So in using the predefined screens, it's a great way to get some stock ideas that follow our methodology. And I'm doing, as you heard on MCMC, I'm going to be presenting on Green Brick. I've never done home builders. I've heard presentations on it, but I've never really done them myself. So I thought, okay, let me sort of look in the home builder area as well. And, this is a way I sort of can build out an industry study. So the predefined screens is over on that screen capture on the right-hand side in that red box. And then if you look at down below the criteria that the quality and the value screen and the A-list, that's again in the upper right, that light green stuff, that question mark there, if you open that up, it will show you those 3 down there, and it gives you sort of the parameters. If you're a numeric person and understand all that stuff, it's great. But otherwise, you just have to know that these are pretty worthwhile places to be able to find it. So let's go to the next slide. And I want to talk a little bit about home builders, and keep in mind that they are cyclical, and that means that they expand and contract with the economy and stuff. And the thing is that they're interest rate sensitive. And again, there's a lot of stocks, almost 3/4 of them have some kind of cyclicality to them. So, we're always sort of told to be able to look for up, straight, and parallel. You may not always get that with every cyclical that's out there. And then also, even cyclicals may have looked like they weren't cyclicals if you just look at the visual analysis going back all the way to 2008, 2009, because we had this long, uninterrupted bull market. It's the longest in our history. So as I said, the home building is interest rate sensitive. And down below, you can see that there's the home builders 30-year fixed is currently at 6.9, whereas really over the last decade, it was closer to 3. So that's sort of something to keep in mind. And the other reason why to look at home building is home builders are 3 to 5% of the GDP. In real estate is 15 to 18%. And that comes from the National Association of Home Builders to take a look at it. And there's an image up in the upper right that sort of shows you who's the leading home builder in each state to take a look at it. And up in the upper right, if you got the handout on this, where the image is, if you click on it, that will take you to that link to where it shows you all the state leaders on home building. Next slide. So the home builders are really lightly covered in our community. If you see on the ticker heat map on the right-hand side, only Green Brick and PHM, which is Pulte, show up. Um, and if you see that in the top 200, only one of them showed up. This is from April of last year, and that was D.R. Horton. First cuts, there were several of them that were listed there, and you can see many of them have just one or two studies going on. And Toll Brothers that we're looking at, as I said at the beginning, the one stock that was the one first cut that was put in there is from March of 2022. So we're coming up on 3 years old. At the same time, Toll Brothers has gone up 212%, not including dividends, over the past 5 years, and we're trying to double it. Our goal in the better investing community is see if we can double in 5 years' time, which is 100%. So they've done even better than that. So it got me thinking, maybe I ought to look at this industry a little bit more. Next slide. So what I tend to do when I'm kind of new with this is I like to be able to sort of look at sort of some of the competitors and take a look. And as you can see, I had a lot of things I haven't really sort of filled out yet. And this is sort of how I sort of learn and sort of figure things out. But I look to be able to find all the home builders that were in either the S&P 500, the 400, which is the mid caps, or the 600, which are the smaller ones. And I was looking at sort of general things that sort of come in terms of homes closed is one thing to look at. You can look at the sales as we have in better investing. You can see the regions that they cover. And the one thing that sort of stands out with Toll Brothers is that their focus is really on luxury homes. D.R. Horton does everything from entry to luxuries. You can see others that are much more varied, like Pulte and NVR Home. NVR Home includes Ryan and the like. And so you can see that there's, um, like a lot of industries, I sort of compare it to like semiconductors, that there's a whole range of things inside the home builders that can take a look. So there's, like I said, I'm just sort of starting out with this. I'm not an expert in it, and I'm just sort of fumbling along, and this is sort of how I start out. Next slide. So here's sort of what I look at. So it's a large size in terms of sales by our metrics, but it's in the it's a mid cap component. Um, they're out of Fort Washington, PA, which is Philly. Um, their CEO, Doug Yearley, has been the CEO since 2010. So that means all the leadership is in place. And you can see it has a decent above average financial health grade. A B is above average. It means it's in the top 40% of all stocks in our universe. It has a really good manifest quality and par rating if you use that, if you use manifest, if you're a subscriber to it. But even the value line and CFRA have good stuff. The concern is with Morningstar is you see down there is they don't have an economic moat and just as a standard capital allocation. Those are not negatives. They just don't sit there and jump out. And I don't think any of the uh, Morningstar covered home builders have anything other than a narrow or no economic moat. So keep that in mind. Very competitive. Next slide. So I also like to look at the CFRA report, and what it does is it gives me a nice summary of stuff that really they've submitted to the SEC. So again, they cater, Toll Brothers does, to move up buyers and empty nesters. So also when people are trying to downsize, they want to do luxury downsize. Most of their homes are built on the East Coast, but they do have a presence in all the growing communities across the country. So that means California, Arizona, Washington State, Colorado, Utah, Nevada, Texas, of course. And you can see that. And one of the ways they can sort of reduce their risk is that they control the land, but what they do is they subcontract out the people that do the actual building, and they do a lot of subcontracting. So they spend a lot of money on land acquisitions. And I heard the CEO talk about this about a year and a half ago, that it takes them about 6 years from when they acquire land to before when they're able to start building on it because of permitting and everything else to go with the title. And what they also have done besides land acquisitions, they've been spending a lot of money reacquiring their shares outstanding. And they've reacquired 5% of their shares outstanding since 2016. Next slide.
5 minutes, Kevin. Five
Thank you.
minutes.
So I also like to look at management and sort of scuttlebutt. So you can sort of see that it has pretty good metrics in terms of what the CEO rating is and how to work on it. But here's one of the things that uh, Toll Brothers likes to point out is that they're 10 times Fortune's the 10 times they've been on Fortune's most admired companies list. They've gotten Builder of the Year twice. And like I said, they seem to do a lot of these things that they're really proud of. And it shows up in a lot of the things I sort of found by doing Scuttlebutt. Next slide. So in using visual analysis here, if you see this is you can see in Core, if you go to the third step there, you can get the equivalent to what we'd have on the first page in Plus, and you can see where that red star is. I took out all the early years of the sales because I wanted to really see how it operated since the pandemic. And as you can see that down at the bottom, that's a 6.2 growth. And the earnings, I didn't do that because it seems to be growing at that same rate kind of consistently all the way through. I could have done it, but I didn't. Next slide. So here's some of the competitors. I went through it. I basically kept the ones that were in there. That's Pulte, DR Horton, and Lennar. You get a Class B. That's the B shares. But I give you a wide range of stuff. I like to look at Craft to find stuff. I go over to Manifest. I look at stuff on Value Line. And that's in the center. That's Morningstar in the maroon and CFRA down at the bottom. And I was getting pretty much the same stuff I really thought. So I decided I'd keep the original ones. Next slide. And so going through the competitors, if you look at this, really Toll Brothers is not doing as well over the 5-year average, but again, it's the one in black. But if you look at the last 2 years, 23 and 24, only Pulte Homes is ahead of it. So it's gotten better than DR Horton and Lennar over the last couple years, even though the 5-year average is below. Next slide. And with the return on equity, again, you can see it's sort of bounced ahead of everything other than Pulte. Pulte hasn't announced what they're doing in 2024 yet. They'll come pretty soon. But all of these are really decent numbers. But Toll Brothers has gotten better over the last couple years, where some of the others have sort of slowed down. Next slide. If we
2
look at
minutes, Kevin.
thank you, debt to capital, if we see that, again, it carries a higher debt to capital, which we prefer to have it lower, and Lennar's the best at it, but it is trending down, and that's a good thing to see. I'm not really worried because they give a really good financial health grade. The B is a really good metric and everything else. So I'm not really worried about these overall, but it's just good to know. Next slide. So when I'm estimating future sales and earnings, like I said, I took the 4-year historic average so I could see how it's performed since the pandemic, 6.2. If you look at the consensus estimates in the center there, they're looking at 3.4. But that's only 2 years out. And I think as things sort of straighten out, that I think the 6.2 may be a pretty good place to go. And that's where I settled things. And then the 10-year historic is around 25. And so what I did is I forecasted future sales at 6.5 and future earnings at 9.6. And again, with this evaluate management in the lower left-hand side, they're all pretty good metrics. So I feel like this can hold out, even though the 2-year average is 3.4. I think it's pretty reasonable. Next slide. So when I did the historic highs, PEs, I went with 12, and the historic low, I went with 5. That's the one that's sort of in the orange at the bottom, and that sort of gave me my high and low prices. The current price is 124.6, so I am getting a doubling of the money. And the like, so I can take a look at it. But I also gave it, because it's cyclical, I decided to go down much lower than just the 80%. The 80% is just around $100, and I'm setting a low side of 75 just because of the cyclicality that goes on with this. Next slide. So with my 5-year potential, I get it as a 2.9 to 1. And when you get that close, it's really sort of your decision on what you want to do. The payout ratio is pretty consistent. I kept that where it was. And so I'm getting an average rate of return, including the dividend, at 17.3. So I'm clearly getting there. But again, the upside downside is showing it not at 3 to 1. And part of that is because of the dividends that aren't accounted for in that upside downside ratio. Next slide. So my conclusion, it's a large size, steady growth company, not spectacular, has above average, but not great metrics. Many of its competitors may be slightly better on it, but they're the only really true player. I say I have a typo there, not try, but true player in the luxury market. And that's where a lot of the growth is coming on with that. And a lot of the stuff I read with interviews with him seemed to talk about it. If we use historic data, Toll is probably considered overvalued, but using these projected data, it's undervalued. And you can see that the 5-year forecast is 8.5 and it's at 8.3 currently. So I have this as a buy up to 123 and 60 cents. And that's just a little bit, just almost $1 below where it currently. So it's sort of in that in between buy and hold. If you believe the prospects are good for future home sales, particularly luxury sales, and again, about 20% of the people that buy from Toll pay cash. They don't have to, they're at a different level than most of us, and their average purchase price is around $1 million. That's where Toll is sort of in that niche. So that's where I came with it, and that's my presentation. Thank you. And let's go to the next slide, and we'll start looking at the ones in plus. We're introducing Helen here. Helen, I think it's going to be our 39th different presenter. She's going to do Ball Corporation. And she has a special place in my heart because when I started my first club around 24 years ago, she was the director from the DC area that came out to visit with us. And I know you probably had just gotten out of college 25 years ago. So you were a go-getter from the beginning. So Helen, take it away and tell us all about Ball Corporation.
Next slide. Thank you. I'm Helen Albanese. I lived in the Metro DC area for about 50 years, and 3 years ago moved to Atlanta, where I'm a member of the Georgia chapter. I'm an individual investor, meaning I'm not in a club at this point. My stock presentation tonight is for Ball Corporation, and it is the BI Magazine January 25 undervalued stock, and the magazine is not yet published, and you can guess by looking at the graphics here that they are in the business of aluminum, and they were in the glass business. Next. This is a sample from the December magazine of the undervalued feature, which is each month. It shows up in the index here on the left on page 26. The December stock undervalued was Young China Holdings, and then you'll see on the right a sample of the write-up that's done and available to read and study. Next. Hopping right in, Ball is on the New York Stock Exchange. They're a large company, $18.8 billion. And their sector is consumer discretionary. A red flag there for what's been going on over the last few years, and we'll talk about that in a few minutes. Their industry is containers and packaging, and they focus on aluminum and doing interesting graphics for their clients. They are, as you see on the right, particularly concerned about recycling of aluminum, and they have a 2030 goal of 100% recycling of aluminum. Next. Learning more about them, here's a link to their website, and inside that link, a link to investor relations. The third bullet here I thought was most interesting, a Washington Post article, too much beer and not enough cans. Well, that was what happened during COVID, because nobody was going to bars and there were not enough cans available worldwide to package up all that beer that was not getting drunk at the bars. Interesting story. Next article mentions the project that Ball did with the UK Soccer League. It related to sustainability, and that, as I mentioned earlier, is a key issue for them. Next. Left here is a graphic about their concerns about sustainability, and some background on the company. It was founded by 5 brothers in 1880. Last name was Ball. They started out manufacturing tin cans to hold kerosene and oil and things like that. They discovered that the cans rusted, so someone came up with the idea about using glass. So then they got into the glass business. and of course continued with that until, I don't know, like 15 or 20 years ago, they sold their glass operations to Newell, and they also got into space operations, and because of their glass, they had expertise in optics, have worked on the Hubble telescope. They now are focusing on metal and aluminum cans for food, beverages, and cosmetics, and are the world's largest producer of metal and aluminum cans today because they sold their business related to space systems. Next. Here's a cutout from Value Line. Let's look at item number 1. They are undervalued. Notice that the 3 years there of 22, 23, and 24, the line, the price line is well below that dotted line that Value Line likes to use, meaning that this stock is on sale. That's what we like. And number 2 item, recent price, shows as December 13th at 62, and Friday it was 54. And I didn't check the price today, but I saw that it was even down below 54 over the weekend. So this might be a time to look at this as a buy. Let's look at number 3 here, the 5-year projections. On the left column, 27 through 29 projections, we see a projected high of 145 and a projected low of 95. And the high would yield a 24% annual return, and the low of 95 would yield a 12% annual return. Look down below at number 4, capital structure, and long-term debt showing up at almost $5.4 billion. We'll see that again later in my presentation. This company is heavily leveraged. Next. Some comments from the Value Line certified financial analyst who writes these reports. The post-COVID supply chain disruption caused the lower pricing, as you saw in the last 3 years on Value Line that's talked about. Notice they mentioned Bud Light boycott added to their difficulties. Who would think? Next, the Value Line talks about aerospace division being sold off. That happened in 2024, and that generated for them a very nice profit of about $5.5 billion. And over on the right, you'll see the mention of long-term record of growing earnings per share. And the conclusion from this analyst is that the 3 to 5 year potential of Ball is above average for total return. Next slide. Here's our stock selection guide plus section 1, visual analysis. And notice that the green sales is a little trending down like we've talked about. And over on the right, you'll see the legend, the 4th box down, sales, pre-tax profit, prices high and low, earnings per share, and total debt. Kevin asked me, why are you showing total debt? I said, Kevin, it's not often that a line going down is something we want to talk about. But guess what? Total debt going down is something that's good. So I showed it here. Fundamental company data down at the bottom, our forecast historical sales at 5% and historical earnings per share at 6.9%. Next slide.
5 minutes, Ellen, 5 minutes.
Section 2 and 3 of the stock selection guide, we're showing pre-tax profit on sales at 6%, return on equity at 19%. For a 5-year average, and total debt to capital. Look at all those years there, 2014 through 23. Their average is, everything is above 60% of total debt to capital. Section 3, price earnings history. Let's look at column B. 5-year average of the low price is 52, so that's somewhat in the ballpark of where we are today for the current price. Possible buy. and price earnings ratio in columns D and E, high at 43 and low at 24.9. I like the payout, 33%. That's a good thing. Next. Section 4, I used that $2.62 $2.62, forecasting my high price at $104.80, and the selected low price at 43. Putting this stock into the buy zone, as you'll see in the box at the upper right, zoning at buy and the high and the low there, and the upside downside ratio at 4.6 to 1. Next. Section 5, I use the payout, which we mentioned earlier, at 33%, and this looks really good here. And again, the box on the upper right showing it as a buy. Next slide. Looking at competition, there are 3 stocks that showed up on the competition, and notice that Ball is at the top of the heap here. Next. This is something that I think is very interesting. The audit section allows users of this software inside of BI services to check what's going on with this stock and be sure you're looking at all of the good and the bad things. For instance, a couple of things here. Watch out, caution, sales have declined, earnings have declined, caution, caution. And the very last one, more than 1/3 of this company's capitalization consists of debt. So those are very helpful things for those of us who are new or getting back into doing stock selection guides and evaluation. Next. Also, member sentiment. This information is gathered from other people who are members of Better Investing and have submitted stock selection guides to our national organization for analysis. Next. Same thing, member sentiment, judgment forecast. These are, see across the top, the numbers, the names of the columns here, and what everybody who has submitted stock selection guides think about this company, how they think, how they compare. There were only 23 studies submitted in the last 90 days on Ball Corporation. Notice on the left column that the ones that are white boxes, those were cast out for some reason. They didn't quite fit the correct criteria. Next. In conclusion, Ball is a large-sized, mature growth company. 140 years, yes, probably mature. They are fairly well managed. Ball is on sale, as I've mentioned. They're trading near their 5-year average low PE. They are a buy up to 58, and they have a long-term consistent earnings growth, and quoting from Value Line, at current price, the stock offers us above average 3 to 5 years total return potential. Next.
Thank you very much, Helen. I'm glad that you were able to come on in there, and for your first go at this modern technology. A phenomenal job, but it just shows you've been doing this for so many years that it works no matter how you put it together.
Thank you.
Cynthia, last but certainly not least, tell us all about Deckers.
All right. Good evening, everyone. Again, my name is Cynthia Bonham, and I'm a proud member of the Maryland chapter and a member of the Invest in the Black Investment Club. Today, I share my insights on Deckers Outdoor Corporation, better known by its ticker symbol as DECK, D-E-C-K. Let's go to the next slide. All right, let's begin with just looking at how I identified DECK as an investment opportunity. I used the BI website. which provided excellent predefined screen. I was able to filter and analyze a club that I wanted to get to. The platform allows me to narrow down options based on metrics that align with my investment goals. For example, I went into the predefined screen and I looked for, my sites were on small to medium companies and with a grade A financial health, if you will, A, B, or C. And I came up with, went through the list and came up with a filtered list that I put together, and you can see that at the very bottom. So looking for small to medium companies with an A, B, or C financial health gave me the list below. So now I've created my filtered companies, and I can click on that and it'll all be there until I delete any one of them. So that's how I found DEC to be my investment opportunity. Next slide, please. All right, a little bit about Deckers. It's in the footwear industry. It is a consumer cyclical, a medium-sized company. And again, what I was looking for, a financial health grade of A. It was founded in 1973. It is a leader in the global footwear and apparel industry, known for its innovation and its consumer obsessed brands. So it establishes a strong reputation for targeting specific audiences and delivering exceptional customer experience rather. And it's definitely known for this in their direct to customer channels. All right, next slide, please. All right. Diving a little bit into some key highlights that caught my attention. DEC focuses on a global consumer, and I mentioned before, obsessed brands. I know when you hear Deckers, you just, okay, Deckers, but when you hear a little bit more about Deckers, you dig in, if you hear Uggs, kind of perk up. It's like, oh, I know Uggs. So it is an obsessed brand that's fueled its market leadership. Over the past 3 years, Deckers has achieved double-digit growth in revenue and diluted earnings per share. Look on the slide here. I put it there from FY 20 to 23. The company's revenue saw a compound annual growth rate, the CAGR, of 19%, while the diluted EPS grew a remarkable 26%. DEC's financial health and strategic prioritization makes them a standout performer. Next slide, please. So the next two slides will give you their product portfolio. This one features a lot of the UGG products. The portfolio for DEC is a testament to its versatility and innovation. The company also well-known brands Uggs, Hoka, Hoka, let me make it say it right, and Teva, which cater to the diverse range of consumers. Each brand is designated and designed with a specific audience in mind, from casual to lifestyle wear to high-performance athletic gear as well. The diverse portfolio strengthens DEC's market position and mitigates its risks. So these are the next two slides. So this one and the next one, please. Awesome. And then there's the Hoka portfolio as well. All righty, next slide, please. Turning to financial performance, let's see. DEC consistently delivers impressive results. The company's profitability and growth metrics are top tier. For instance, its ability to maintain a high compound annual growth rate for both the revenue and the EPS underscores the operational efficiencies and strategic foresight. These numbers reflect not just growth, but sustainable growth, which is critical for long-term investors. And again, this is the snapshot. Next slide, please. Here, I want to speak a little bit about their strategic drivers. I pulled out 3 points here for long-term under evolving Deckers and to meet challenges, and also for the shareholders, if you will. So the strategic marketing, and then also put out their good and omni channel leaders, but I'll get into that. So omni-channel leadership, which ensures a seamless integration of online and offline sales channels. And then again, I mentioned the grade A financial and profitability profile that they have. It's supported by their disciplined execution, their innovative marketing strategies, and these drivers help debt capitalize on emerging opportunities while maintaining resilience in a competitive marketplace. This is a consumer secular, and also it's a footwear. So the competitors are out there. Next slide, please. All right, moving into the SSG on the plus side. All right, here, what I wanted to pull out. Let's see. So first of all, just analyzing their growth trajectory, the SSG plus spells it out. This visual is here for us. So this is what we look for when we're in BI. We look for the up, straight, and parallel. And this one tasted real good for me when I jumped in and saw it. But one of the things I wanted to share with you also, if you look to the right, that grid there, one of the things I do when I do the research, and I'm looking at different research vehicles and listening or reading on different analysts, I usually pull out what they're saying and pull out the numbers and pop it into a grid. So that way I can kind of see everything at a glance, if you will. And the thing I like to do, well, the thing I was taught when I came into BI, I'm just 3-4 years old into BI. I was taught that you're not trying to beat the market all the time or beat the analyst, but be comparable. So this is what I do, and I usually just carry the numbers and I get the average. Looking at the average kind of guides me on the route I would like to go, because I could be aggressive, but sometimes that can slap me on the head and kick me in the butt. So I want to be mindful of that. So if you look at the historic table at the bottom for the sales, let me big it up so I can see it. The growth rate here in the SSG is 10.2. For the EPS is 39.3. I looked at my grid, kind of caught the averages, and then doing the research, how it kind of dictated or indicated some things that guided me on where I wanted to go. The average for sales on the grid is 11.35. So I went on and took it up to 12. I was comfortable with that. And then for the EPS, it came in at 14.4, even though the growth historical data tells you 39.3, they may or may not be able to sustain that. So I just went with the grid and just was conservative and went with 15, took that 14.4 up one. So my forecast for the sales and EPS is 12 and 15. Just remember those numbers. I also want to point at the bottom of this slide, the evaluating the management portion, the PTP, the pre-tax profit, the ROE, the return on equity, and the debt to capital. As Helen mentioned, sometimes you want to show what the debt to capital looks like. In this case, it's not red and it's not, and it's going down. So that's a good thing, but it is green, showing that they're doing well with their debt. All right, next slide, please.
4 minutes.
Thank you. Mm-hmm. Here, I just wanted to give you another shot of what it looks like in SSG Plus. Again, you can grab this and same information, but now it is just kind of in a different format, if you will. And that can also be found in the SSG Plus side of things. We're going to go to the next slide, please. Also, competitors. Okay, when comparing DEC to its competitors, it stands out due to its consistent growth and profitability. I keep saying that because it really caught me. Using the company's the graphs here on this graph here in front of you, you can see the companies that took was Crocs, On Holding, and Burks. I didn't pick Nike or something to that effect because it wasn't, for me, comparable, because these are all medium-sized companies and I didn't want to bring a large or a mega-sized company into it. I wanted to definitely compare the competitors that's on the same boat. So they are all medium-sized companies. And if you look at Deckers in the black line on the grid, it is above all. But also, if you look at the numbers, the two I want you to pay attention to is its peer group average. It's above that. Deckers and the rest of them are above the peer group average and the industry average, which falls in at 6.6. So they are all exceeding the peer and the industry average. Just wanted to take a look at that. Next slide, please.
2 minutes, Cynthia, 2 minutes. You're doing great.
Awesome. Here is the valuation. Just wanted to let you know. So here, my forecasted high price. My forecasted high price came in at $215.10, and then the low came in at 107. If I didn't pull it out, but on some of the other screens where I had the grid, you can actually see where the average came in, because I did have high price on there, and it was about the same, similar. But anyway, what it does here in the 252, which is the 25.50-25 zone, it comes in the current price at 207.30 on the sale side of things, the 215.10 being the high and the 107 being the low. It is currently in the sell zone. What else can I say about this? Let's go to the next slide. I'll give you a little bit more. All right, so DEC is a medium-sized, steady growth company with strong management and financial health. While it is currently trading at a premium, it remains worthy, I believe it remains a worthy candidate for your watch list and potentially your portfolio when the price is appropriate. So I'll put that disclaimer in there, when it's priced appropriately. Its strategic drivers is diversified portfolio and its solid track record make it compelling long-term investment opportunity. So consider Deckers for your portfolio. I do want to say for investors seeking a 15% total return, DEC becomes a strong buy below 134. It is currently at 207.30. Thank you. Next slide, please.
Okay, thank you, Cynthia. So we went through all four of these stocks. Sometimes we maybe spoke kind of quickly and you couldn't absorb what was on that slide. So please make sure to download these the slide deck. And we'll show that over at the end. But now we sort of like to have all of our presenters sort of talk about where it fits on the life cycle. And Cheryl, if you go to the next slide, please. This comes from T. Rowe Price. It's also in our handbook. And it's sort of from T. Rowe Price, he talked about how corporations sort of pass through a life cycle, sort of like a human, where they have growth, maturity, and decadence. And so we want all of our presenters to sort of tell us where you put this on there. And we're going to start with you, Kent, since you have one that really stands out.
Yes, it does. I put Merck way out at the far right and in the stabilization area because I believe it's a really stable growth company. I don't believe it's in decline at this point, but I do not. Based on what I've seen, it would be a really good dividend producing company. It's going to be around for a really long time. So your grandmother would be really pleased to have this, or your mother, depending on what our ages are. But I think this would be something that one would put into an income-based portfolio as opposed to an income-seeking portfolio versus a growth portfolio.
Okay,
so that's my.
Thank you. With Toll Brothers, I have it sort of in mature growth. It's been around since '67. It's very competitive. Like Morningstar says, there's not a real moat with it, but they do have a niche where the others aren't, and that's in the luxury home market. That the others have some play in it, but that's their bread and butter right there. I think it can be in this area for a long time and do really, really well. And it's going to have maybe high single digits to mid single digits sales growth. But with that, and because of the way it's able to manage stuff, they can get a little bit higher earnings growth. And I think you can be able to find some really good prospects with it. So with that, let's turn it over to Helen and tell us why you picked that location for the Ball Corporation.
Hello, I'm Helen, and I picked mature growth toward the upper end for Ball because they're an older company. And the other thing I like about them is they are highly focused on their product of aluminum cans and metal cans for products that people are using. The one issue is the possibilities of being consumer cyclical, and we saw the damages that they suffered during COVID for that. But I think they have a strong management team in place, and with the sale of their aerospace division, are seeing ways to deploy their money in things such as reducing their debt. And they did a stock buyback also. Mature growth for Ball.
Okay. Cynthia, tell us why you picked that location for Deckers.
I have Deckers sitting right below mature growth. They sit comfortably at mature growth, but they are still explosive. And I say that because of the brand, of who they work with. Uggs. I think of Uggs like an oldie but goodies, Motown hit, where when you hear it, it can be gone for a while, but when you hear it again, everybody jumps on it. It's never going to die type of thing. But it just indicates it's steady performance with room for expansion. For those investors that's looking for balance between growth and stability, yeah, this is why I put that there. They're still growing, but they are stable. They are definitely stable.
Okay, thank you very much. So we've been chatting now for about an hour on all the different stocks. Now it's time for all of you to chime in. And Cheryl, if you go to the next slide, this is where we want you to sort of pick out which one interests you. We're not saying which one you think should be the one to buy, rather which one intrigued you enough that you want to do some additional research. Because again, we're asking you to, do your own research. So Cheryl, if you can release a poll and people can vote, and we'll see how things go. There it is. Poll is open. Doesn't cost anything to participate. It's free. You get to vote just once. We have a pretty close race going on here. About 50% of you have already voted. Let's see if we can start to move that up. We usually like to get it into the mid 70s. Oh, we're moving fast. We're now at 67% of you have voted. Can we get a few more of you to vote? Give me a couple more. See if we can get up there. This is a really, really tight race. I haven't seen one this close in a while. So go ahead. Someone can do one more vote and see what they can get. They could swing the whole election. I don't see anything moving, Cheryl. So let's see. I'm going to count down slowly from 3, 2. Got one more vote there. 1. Any more? Okay, go ahead and close out the poll. And so there you are in a very, very tight race. We have Deckers winning, but Toll is right around the corner. So when they get that close, we usually say, okay, that's good enough for all of us. But Ball hung in there, but no one really wanted Merck today, even though that's a stock to study. Anyway, Kent, now I only saw that there was one question in there. Barbara from the audience said that she has already received her January, February magazine. So that's good to know. Maybe it's starting to come out. But if anyone wants to raise their hand, we'll do it that, or you can write in the question box if you want any questions of any of the presenters on their particular stock. Kent, if you can keep track of that, that would help.
Okay, will do.
Any hands? Go ahead. Let's not be shy. Let's see if we can participate and be part of our larger community. Any thoughts?
Kevin, this is Cynthia. I just wanted to say for Kent, awesome. I love the way Kent kind of really dug down and shared with. I know we run through these presentations quite fast, but to be able to share with the audience how, if it was a bump in a rug or whatever the case may be, it may not have looked good, how he really dug down and some of the things that he looked at in order to go dig a little deeper. So I love his deep dive and I love the way he presented it tonight. Just wanted to share that. I know that might have been on some other beginners' minds. It definitely was on mine, the way he went about digging deeper. So thank you for the deep dive, Kent.
Well, thank you for the compliment. You're welcome.
And the other thing is if you look in the notes section of Merck, I attached this to the SSG, is that they have staff notes sometimes when there's something unique about it. And they do have a staff note about Merck, and Kent did talk about their acquisition and how that's doing it. So it's sort of mucking up some of their numbers there. But go ahead and read the notes on that or download your own and you'll be able to see that. Any other questions or any hands raised? Do you see anything, Kent? We are quiet as a bunch of church
Yeah,
mice.
it's pretty quiet. So
Yeah.
nothing out there. So I think we're good.
All right. Well, let's just keep going. And we'll go through this. So if you have any other questions, you can be able to reach us either at the DC chapter or the Maryland chapter. They're the two stuff for that. If you have anything for this particular event, the Digging into BI, the joint program, you can be able to reach us at digging.into.bi Gmail. And here's a picture of a bunch of us that all were at Bink in Chicago in May, back when we had warm weather. And look at the entire crowd there, and it's really a nice, good cross section of the two chapters. So thanks to all of the people there. In fact, several of them are in the audience if they're not presenting. So thank you for that too. Let's go on. And if you want to join our mailing list, you don't have to be in the DC regional chapter. You can sign up here, and there's the hyperlink up at the top, and you can get notices. We don't inundate you. It's just really our announcement of education in this Digging into BI, and you can get it. And again, share it with people both in our community and maybe even prospective folks that want to do it. Next slide. Kent, why don't you tell us about how to volunteer?
Awesome. Well, so first I'll tell you about some of the benefits that you get for volunteering. And the biggest benefit is learning new skills. And as Cynthia mentioned, I learn a lot every time I do a stock study, especially of companies that are unfamiliar to me. And so Merck was one of those that I learned a lot from by digging through their 10K and their annual report. But then I also get quite a lot back by helping educate other folks and answering questions. So that's been very, very rewarding for me. Finally, if you would like other options, you can get yourself some new investing information by attending the BI National Conference and getting discounted rates for that. You can also get the online data feed as well as using the stock selection guide. And that way you can get complimentary subscriptions for. So that's really a good rationale for becoming a volunteer. And as Kevin mentioned early on in this effort, every single one of us who is participating tonight is a volunteer, either as a chapter director, has been a chapter director, or continues on at the national level. So all of us are volunteers, and we enjoy doing this and helping you. So that's it. Next slide.
And for those that don't know, Kent was one of the people that taught at Bink, and he was doing the Beyond Beginners program that you did? You joint taught that one. Is that what it was, if I remember?
That's what it was, yeah, Beyond Beginners.
So great thing to take a look. So keep that in mind when they do that at the national conference. So they're doing another one in 2026. In the spring, early summer of this year, we're going to do an online version of it. Anyway, here's the stuff that's coming up for February. The stock to study is NICE. The undervalued feature is Cisco. And then we're going to have two more, Palantir and Powell Industries. And actually, 3 of the 4 presenters are here tonight. Cheryl and 2 people in the audience are there. So thank you very much for being part of this. We appreciate it. And come see us on February 3rd, and we'll even have the magazine by then. So we should be a little bit better prepared. But we learned from this one not to do that first Monday in January. It's too soon. Next slide. So I have up on Manifest public dashboards for all of these things. So you don't have to be a member or a subscriber to Manifest Investing to be able to see this, but they're all up there so you can take a look at it. I've been delinquent in not getting some of these up there in a while, so I've got to spend a night or so getting them all together. So I'm slacking a little bit, but it's nice to sort of see how they do over the year and stuff like that. So next slide. And I'm seeing, do we have any questions? No, I was doing some private chat. So here are the hyperlinks. So again, make sure to download the slide so you can do that. And all of these hyperlinks should work to get you over there. And one more slide. So this is where again, this underline here, this will take you to the YouTube page to take a look at it and the like. And all. Any other questions? I see Richard has responded. Thank you. You'll be a presenter in April. So that's great. We're filling up. Again, if you're kind of new and inexperienced at this, Cheryl or I will help you out. We have a template to sort of help you go through this. Even if you have some experience and you want to sort of work with someone, we have several people that want to be able to help out. Like I said, we have so many different people that have presented. It's always great to get someone else's understanding. I remember when we started this a little over 4 years ago, some of the veteran directors in the DC chapter were like, they really like seeing all the different ways that people put together stock studies. So if you want to be able to get a little bit better at your own stock study and also promote your club through the Club Connect, we can do that as well. And you can reach out to either the DC chapter where Cheryl will reach out, or you can go to the Maryland chapter and it'll either be Cynthia or probably be Anna that reaches out to you. We'd love to have you. Anything else?
Last month we had a problem with the handouts, and anybody that still needs the November handouts, please send a message on that contact email and I will get them to you.
November, you said November, do you mean November or December or both? Tell you what, if you want to get one, if you're in the audience and you want it, just send to that email and Cheryl or I will reach out to you and get it to you. So,
yes.
Sorry we didn't get that up. This is what you get when you have volunteers trying to do new technology. So
no, this was the fault of the website. So
yeah, we'll blame it on them. And when in doubt, always blame it on the young kids with the internet. Anyway, anything other than that? One last time for questions. No hand raising. I don't see anything. Got everyone quiet here. I guess probably because we did such a great job with our presentations that we just floored them with that. I think that's what happened. What do you think, Cynthia? Oh, I think Richard has his hand up. So Richard, I'm going to unmute. You're now self-muted. So if you hit the microphone and open that up, if you want to be able to talk, if there was anything, go ahead.
I double clicked it. I am now unmuted.
There you are.
I just wanted to say that.
Down. I would
appreciate
it. Richard wanted to say something. Go ahead, Richard.
No, I know. That's why I want to leave it to you, Kevin, to shut it down.
Okay, very good.
So I found that the Cole Brothers was kind of interesting. We at our investment club, Blue Chip, we have an investment in DHI, which is it caters to the clientele which doesn't have deep pockets like I do. I find it quite interesting that many of the customers that do business with Toll pay for their investments or the housing project pay outright rather than committing to a loan.
Yeah,
I find that quite fascinating.
It is. I mean, as the CEO said, about 20% of all their people pay for their stuff in cash, or they're transferring, they're upscaling from a previous home and stuff like that. And their average home sale price is around $1 million, and the average, I think the median home sale price in the U.S. is somewhere just short of 400,000. No, it's between 400 and 500,000. So
I read that,
most,
and I also they have a new ongoing project in Franklin, Tennessee, which I was in Franklin, Tennessee, last November,
mhm, very
just
good.
near Nashville. So they probably have lots of uh, entertainers on their clientele list.
Mhm. Okay. Anything else you want to add about home builders? Because like I said, I got one more I got to do in a couple weeks on green brick.
I follow IBP, so
Oh, install building products. Yeah,
right.
that one's
They're not a home builder, but they have to do with installation of fireproofing and things of that nature. They're in the big in the acquisition market,
yeah,
acquiring other companies.
one of my clubs. We did a present. So we had someone do a presentation on investors install building products, but I think we eventually took it off our watch list and never purchased it. But yeah, I mean, sometimes you need to hear these things two or three times before they finally click for you. Um, so, how long has your club owned IBP?
I first presented it to the club in 2022. So we've owned it since then.
And have you guys done
Since
well with it?
they, yeah, we purchased. I think that we purchased it honored shares for 110. It dropped down to 60 and cruised past 200 this past year and is now in the 170s.
Very well. You're
So
making money.
in the
That's good.
long term, in the long term, we're looking at the long term, and Value Line and Morningstar both predict it to be it's a good long term investment.
Very, very good. Okay, I saw one hand go up and then go back down, so I'm going to assume that was an inadvertent. But if anyone else wants to be able to talk, I know people are leaving, and that's certainly fine. You don't have to stay all the way through the end. But if there are any other questions on stuff like this, please let us know. Raise your hand or put a comment, send something in the question box. I don't see the question box is really, really quiet tonight. But thank you, Richard. That was very helpful.
You're
Okay,
welcome.
without anything else, we're going to shut down. I'm going to give everyone a little bit more time, but we're going to end things now. You can take off. I'm going to keep this open for another minute or two in case people want to get to that handout. But otherwise, we will see you next month on February 3rd, as Richard pointed out to me, one day after Groundhog's Day, and with those four stocks, NICE, Cisco, Palantir, and Powell Industries. So come back and visit us next month when we dig into the BI. Thank you all and have a good night.